Thank you so much for joining us for the second part of this webinar with Michele Garbus. My name is Larissa. I'm with Advanta IRA. And for those of you that may have missed the first part to the webinar, it is posted to our YouTube channel. It is available. And also when we send out the recording for this one to all the registrants, you'll also get the recording for the first part. So if you did miss it, you'll have the opportunity to go back and listen, and you'll also be able to listen to the second part as well. Again, thank you so much for joining us. My name again is Larissa. I'm with Advanta IRA. We do self-directed retirement accounts, and we've been doing so for about 16 years now. We are here in Largo, Florida. We're also in Atlanta, Georgia, but we can help clients nationwide and even worldwide. So we have clients invested worldwide, but we also have clients because they have a U.S. retirement account that live worldwide and invest through a self-directed IRA. So that's basically what we do. And I'm not going to go too much into it because I want to give plenty of time for Michele to get into the second part of the webinar on private lending in first and second mortgages and how to turn them to into profitable investments personally and also for your self-directed IRA. So that's what we're going to be talking about today. Advanta, basically, we provide record-keeping services for your self-directed retirement accounts. So that's what we do. We don't sell any investments at all. We simply hold the account for you and help you make the investment of your choosing. So whether that be into non-performing notes or buying real estate, that's what we're here for you for. What we don't do is give legal, tax, or investment advice. So we're here to help you understand the rules for your self-directed IRA, but ultimately the investment that you make is going to be up to you. Now, if you do have questions and you're not sure if they fall under, legal, tax, investment advice, or just simply finding out about the account, ask anyway. And what we'll do is if we can't answer them, then we can provide you referrals to professionals that can help you with those questions. So, please don't hesitate to reach out to us. I do want to mention before I go on that everybody is muted for the sake of the webinar, but if you have questions, go ahead and type them into the question box and we'll make sure to get your questions answered. We'll take some questions throughout the webinar and then we'll also allow a few minutes at the very end for questions as well. If you haven't heard of self-directed IRAs prior to joining us for this webinar, possibly the reason is because there's not a lot of companies out there like Advanta that allows for self-directed investments. And, brokerage accounts, those are great firms, Charles Schwab, Morgan Stanley, Fidelity, all great firms, but they've kind of made it a business decision not to hold private investments. They consider them maybe risky from the standpoint where they can't advise you on them, and they also consider them hard to value. And so what we've done is filled the gap in that industry for private investments. And so we've made it a business decision of ours to only hold private investments. So I can't help you with anything that is traded on the stock market, but I'd be happy to help you with things like private stock, real estate, mortgages. And there's so much more to a self-directed IRA. We even see people invest in things like racehorses and cattle, foreign currency exchange, and Bitcoin. So again, there's so much out there for a savvy investor who wants to take control of their retirement account, and that's what we can help you with. And just to kind of give you an idea, it's actually less than 4% of all retirement accounts that are truly self-directed into private investments. And so if you have questions on self-directed accounts, please join us for any of our upcoming webinars. You can find them by going to advantaira.com/events. We have webinars every week. If you're near one of our offices, we also have lunch and learns twice a month where you can join us. And we'll also teach where we're invited. So keep that in mind. If you happen to be a real estate agent, for example, and you see us coming up on the calendar for your local community, because that's kind of what we do is we get invited to local boards for real estate agents. We do continuing education for agents. We also do them for CPAs, enrolled agents, and we also do them for attorneys. So, that might be a reason that you see us in your local community. So with that, I want to introduce Michele Garbus. She's going to take over for the second part of True Grit of Mortgage Note Investing. How are you today, Michele?
I'm doing well. How are you doing?
Great. Thank you so much for joining us. I'm really looking forward to it.
Thank you so much, Larissa. I appreciate you working with me to do this and really help to educate people about non-performing mortgage notes. We do talk about performing mortgage notes as well, But our company, what we do is we buy non-performing mortgage notes mainly and get them re-performing. So welcome everyone to part 2. In part 1, we talked about the opportunities of mortgage note investing. And as I mentioned to everyone last week, we've been doing this for a very long time, and we've been doing real estate for a very long time. And all of our experience really led us to mortgage note investing. And by far, it for us has the biggest opportunity and is something that we absolutely love. We've done a lot of short sales, a lot of subject twos, a lot of rentals and lease and holds, and we just really like non-performing notes because when we get them performing, they really set us up for our retirement years. And I think that's one of the things that's so beneficial about IRAs and 401ks. We also talked about mitigating risk in notes, and one of the things that we talked about was that if you understand the risks and you know how to mitigate those risks, then you're going to be better prepared to be able to do non-performing notes well. I think with any investment, everything carries risk. All investments carry risk. But if you know how to manage those risks, then you're one step ahead of making sure that your investment is going to be successful. So we spent a lot of time on that last week, and we're going to kind of continue that this week because we're really going to be getting into the dirt of mortgage note investing now. And if you didn't get a chance to listen to last week's presentation, I recommend that you definitely go in there because we'll refer to that a little bit throughout. But it really talks about some of those risks and how to mitigate those. So anyway, the other thing that we're going to talk about is the pricing, as I was saying, and what you can expect in terms of pricing. This market is a little bit higher pricing, just like everything in real estate. Things have gone up. So I'm going to give you a realistic view of what you can purchase notes for now, both first and seconds. And then also kind of what we were seeing in the past as well. And then in addition to that, we're going to talk about the mud that you can get into and mud slinging that actual borrowers will throw your way, as well as attorneys will throw your way, and how you can get out of that mud. So with that, we'll go to the next slide. Okay. So we're going to talk about, at the beginning, really kind of playing in the dirt. And what does that look like? Go ahead. Okay. So first of all, we're going to talk about risks. So when you're buying notes, these really are, I think you went too much. Okay. Oops. Where's my? No, you didn't. I'm sorry. That's me. You're good. So, the first thing we'll talk about is the industry dirt and, what happens in this industry. And when I say industry, I'm really talking about the notes industry, right? So, one of the things that you guys really need to be aware of is that, especially right now, there's a lot of bad loans out there. And so when I say bad, that may mean that to give you an example, as a second mortgage, that loan was already foreclosed on and wiped out. And when we purchase loans, we want to purchase loans that are secured loans. So we want to make sure that they're secured by the real estate. So when I say bad, that's what I mean. They're really not secured anymore. So how do banks and hedge funds and gurus really get rid of those bad loans? Well, the way they get rid of them is they're going to sell them to people like you. So what that means, as we talked about last week, is it's really important to do your due diligence and make sure that when you do that, that loan is still secured and is going to be in good shape to be able to either get it reperforming, or if you have to foreclose and get it sold or rented or whatever your exit strategy is. So one of the things that's also happening out there is there's a lot of people that are advertising basically that there's a number of notes that are still out there for sale that are non-performing notes. Well, there is definitely inventory out there, but one of the things you should be aware of is that people are actually double counting and triple counting the inventory. So as a result, that they're talking about a lot more notes than are actually available. And so because they're double counting and triple counting the inventory, the result is there's actually lower inventory on the market. And a lot of people have either refinanced or done something so that they are, in fact, they're having some inventory out there, but there's not as much out there and a lot that is not as good that is out there. So what's happening because there's lower inventory is the pricing is actually going up on that inventory. So we're going to go ahead and talk about that. Larissa, I think I'm back, so I'm going to see if I can move this.
Okay.
I don't know if that was you or me, but here we go. So the risks are that the first thing you want to make sure is that the actual note that you're purchasing is a valid note, meaning it's not stripped. It's a good note. It hasn't been robo-signed. We'll talk about this more in detail. And you want to make sure that when you're buying notes that the pricing is correct on those notes. And the second thing is that there's some equity in the note itself when you're buying the note. So to do that, you're going to run comps on the note itself, or really the property itself. And you want to look at the neighborhood and what the neighborhood is doing. You want to look at natural disasters. Baton Rouge just had a lot of flooding going on, and that could affect the value of the home, which of course is going to affect the value of the note itself. So making sure you're aware of those natural disasters is a risk that you need to make sure you're overcoming. How has the note done in terms of bankruptcy? Has the borrower filed bankruptcy? If they have they stripped you? And we'll talk about this stuff. The same with foreclosures. We want to make sure that the note hasn't been foreclosed on. And I would say probably the most important thing, and we'll go into this in depth, is you really need to know the laws, especially in the markets that you're investing in. The other thing is the servicing. How is the note going to be serviced? That's another risk, and all of these things are absolutely overcomable. You just need to know how to do that. And if you do, you can do very well with notes. And probably one of the biggest things to really be looking at right now is a possible another market crash in some type of way. We're not seeing that right now. We're definitely, at least in most of the markets, we're seeing a leveling. In some markets, we've actually seen a decline recently. But no matter what you do, you always want to manage for the downside. So as a result, you want to just prepare for the possibility of another market crash. And one of the things that you do that through is through pricing. You're going to have to move it, Larissa. It's not working. Sorry. So what are the risks in terms of the actual tape or pool of loans? And before I do that, I just want to make sure you guys understand what a tape is or what a pool is. It's basically words that are used interchangeably in this industry. And what it really means is a group of loans. When we get a tape or a pool of loans, we essentially are getting a spreadsheet that is showing all the loans that the seller is trying to sell. So that's what I mean by a tape or a pool of loans. The other thing, so when you're looking at that tape or pool of loans, you want to see if the documents that you're receiving on that tape or pool are legitimate documents. One of the things that was occurring back in kind of the 2006, 2007 era is that they were selling loans like crazy, and they were just being robo-signed by some person that didn't even have the ability to sign the loan. And so you want to look at that. You want to make sure that it's a legitimate signature on the loan. And I'm going to tell you that there's third-party people out there that can help you do all this. So I'm going through this in terms of risks, but I also want you guys to understand that there's organizations out there that can help you go through all of this stuff. The other thing that occurs, and quite often, frankly, is that the documents that you're getting may not be in order. Typically, they're just missing something. So you can get it, and usually what it's missing is called an assignment or an allonge. And you can get those things, but in order to foreclose on a property and legitimately be able to get a borrower reperforming, you need to make sure you have all those documents. The other thing that happens on a tape or a pool is they will tell you that the fair market value of the house is X amount. And if you're buying seconds, a lot of times they'll also tell you that the senior payoff of the first is a certain amount and that it's a secured loan. When we go through our due diligence, and this is why last week was so important because due diligence is the most important thing you can do, we find that a lot of times this data is not necessarily accurate. Just to give you an example, on a fair market value, they can just be doing an AVM or giving you a Zillow value. And we all know that Zillow values aren't the most accurate things. So you want to make sure you are getting a correct fair market value, senior payoff, and that it is a secured note. One of the things that can happen is it could be stripped in a bankruptcy. Now, we talked about that last week, and I'll go into it a little bit further, but it's something that you really need to make sure of because you want to buy a secured loan. And if it was stripped in a bankruptcy, that means it's not secured. It can also have been foreclosed on. And again, we'll talk about this. Or the property could have been sold out from underneath the loan. So it's pretty amazing to me how that happens, because you would think that if a property was sold, then the note holders would have been paid off. Well, there was a lot of craziness going on, as you guys know, in 2008 and in that time frame, where there was so many houses being foreclosed on and so many things that were being sold that a lot of times with some of these companies going bankrupt and out of business, the title companies could not even find those people to tell them that this house was being sold and to try to get a payoff. And so they were actually foreclosing and or they were just selling these houses because they were unable to reach that mortgage lender. So you just want to make sure that that didn't happen to you.
And I did have a question pop up, Michele. This might be something you're addressing a little later, but just in case, the question is, can I go directly to a bank and ask about purchasing notes?
Yes, the answer is yes. And we will kind of talk about that in the pricing section on this, but you absolutely can do that.
Okay,
so
great.
One of the things, and that's kind of coming up here actually, so one of the things that you want to look at is the validity of that note. We talked about the robo-signing, but you also want to make sure that whoever you're buying from, whether it's a bank or a hedge fund or anybody like that, that you're able to get those documents right away. We have seen situations where we are interested in buying a note as in second position, but the first is in the foreclosure process. And as we talked about last week, we're okay with that because we can cure that first. If that's what we want to do, we're good with that. But you have to be able to do that. So if they are slow to transfer you the documents, then that could hurt you in terms of your ability to act on that note. And as we talked about, there could be missing or bad documents. So you want to make sure that you have the ability to do that. And there's people that can be on your team that are experts on documents that can help you with all of this. When you price a loan, you would price the loan in that pool. So in that group of loans, so you might have to buy the entire group of loans, or you might be able to buy individual loans. Either way is possible. So that would impact your pricing, however, because if you're going to be buying a group of loans, and especially if you can buy millions of dollars of loans, your pricing is going to be better than if you're buying just an individual or a single loan. So I'm giving you this kind of in a broad spectrum in terms of pricing, but where we're going to start is how they are priced. And the first thing is that first mortgages are priced based on either the fair market value of the home or the loan to value. So right now, mostly what we're seeing is a percentage of that fair market value. Second mortgages are priced based on a percentage of UPB. UPB means UPB is the balance left on the note. So it's an unpaid principal balance is what that stands for. So one of the things that with second specifically you need to look at is what your ITV is. And that's probably a term a lot of you are not familiar with, which is the investment to value. So based on what you're paying for that note, what is the investment that you're putting in for that note to the value of that note, whether that value is the payoff on that note or the value is the fair market value of the house. That's what investment to value means. And that's critically important with second, because when you're calculating investment to value, you also need to know how much that payoff on the first is, because you would add that to your investment, because if you end up curing it or buying it and you want to rent it, you may have to pay that first off. And we talked about last week how you can kind of get around that because first mortgages like to work with second mortgages. So a lot of times they'll just let you keep that first mortgage in place, but you still have to be able to calculate that into your decision here. So one of the things that happens with banks when you're buying directly with a bank and hedge funds is sometimes they have minimum investments. We just worked with a huge company that sells seconds, and their minimum investment was $1 million. Banks are typically lower than that, but that's also going to depend on the size of the bank. So regional and community banks are definitely better banks to buy from, especially in this market. There's a lot of techniques in terms of how to buy from those banks that you need to really understand and have your kind of act together before you would approach a bank, but it's absolutely possible. The other thing that I would recommend that I would stay away from if you can is daisy chains. And what that means is that a lot of times there's loans out there that are sold to one person who then sells it to another person, who then sells it to another person. That's called a daisy chain. A lot of those loans that we're seeing right now are the loans that have been sold so many times, and that's because they're actually not good loans. So you just want to really watch it if you're getting loans that have been sold multiple times. Again, there can be some good loans out there. You just really have to be careful in what you're doing. Okay. So how does the pricing work? Well, when you buy loans, you can buy performing loans, like we talked about. You can buy reperforming loans, which are loans that have been in a non-performing status and now are reperforming. And then you can buy non-performing loans. So let's talk about how the industry is pricing these loans. And again, as I mentioned, this is a little bit general because part of it's going to depend on how many loans you can take down in one trade. So reperforming loans means that, and different people have different ideas of reperforming, but that they have to be making payments for at least 6 months. We like to make sure they've been making payments for at least 12 months before we consider them reperforming. Most of our reperforming loans have been reperforming for 2 to 3 years, and we have some that have been reperforming for almost 15 years. So just be careful on that. What that means is a loan that hasn't been paying their mortgage and is now paying their mortgage and has been for at least 6 months. The more that they pay their mortgage, the more equity is in the house, which puts you in a better protected position. So typically on first mortgages, we buy anywhere from $30,000 to $150,000 fair market value. We actually have raised that up to about $500,000. We're finding that loans that are a little bit more on the higher side, we're finding more of. So you might be able to look for that type of thing if you're looking to invest. So we like those higher price loans, and we went through that last week in terms of why, because we're more protected on the loan to value. So when you're buying performing first, you're able to buy them for anywhere from a 90% of fair market value or the loan to value up to 100%. So as you can see, right now, those performing firsts are priced pretty high, but they are performing, and performing gives you the least risk. Reperforming are still fairly high. What we're seeing on the market right now is that reperforming loans are going from a low to a mid 90% of, again, fair market value or loan to value. And so again, they carry lower risk because they're reperforming, but that's why they're priced so high. We were able to see reperforming loans a while back in kind of the low 70s area. So you can see how much that the pricing has come up, but yet what I'm not showing on this slide is the actual loan to value or loan to fair market value, because it still could be extremely low risk. Even if you have to purchase that loan at 90% of fair market value, that loan could still be even lower than that. So you could be in a decent situation, and we'll talk more about that on seconds. So non-performing firsts are based on the value, as we talked about, and that's 60% to 80% is what you can buy a non-performing first. As you can see, again, that pricing can be pretty high. If you're buying 80% of fair market value, a lot of times your rehabbers or wholesalers are able to purchase the house for less than that. So you need to make sure that when you're doing your pricing, it really is going to work for you. We don't purchase notes at 80% of fair market value. It doesn't make sense typically to do that. And especially when we talked about that market crash that, I don't know we're going to have a crash like we did in 2008, 2009. I don't have a crystal ball, but I do want to make sure that when I'm purchasing my loans, that I'm keeping that, I'm preparing for a market that is going down and purchasing notes at a price that protects me in case that occurs. So on second mortgages, we purchase anywhere between a loan for $10,000 to $120,000, and that's the loan itself, not the fair market value. So We don't purchase below $10,000 because it typically doesn't make sense for us to do that. You spend more money on servicing and other things than the value of the loan. And 120,000, we like those. So we will do kind of that range all day long on second loans. But again, we need to look at the CLTV, meaning how much is the payoff on the first, and is that first performing before, and then add to that our second mortgage and how much that second mortgage is before we would purchase a second mortgage. So on a second, if it's performing, you typically can buy that second between 50% and 70% of UPV. Reperforming seconds, you can purchase from 40 to 50% of UPV. And non-performing seconds is between 13% and 45% of UPV. Now, we've even seen non-performing seconds go up in price as well from there. It used to be where we could purchase those a lot less than that. Now this is pretty typical, and that's going to depend on how much equity is in that first mortgage. That's why that range is so high, because if there's really very little room in that first mortgage, it's putting you more at risk, and therefore you're going to get a better price. If there's a lot of room where the first mortgage payoff is very low compared to the fair market value, then the pricing goes way up to that 45% level. And we've seen seconds come out where banks have wanted 50 to 60%. Again, that doesn't really make sense to us, and we don't purchase those unless for some reason that first payoff is so low that we think that it's a good deal for us. So the other thing that you really need to look at is the comps and the neighborhood. And we talked about this a bit, but understanding where you guys want to invest is really important. You need to understand the market that you're investing in, and you'll see that in upcoming slides. So we purchase all over the United States, but we don't purchase in places like New York, New Jersey, and Illinois. And there's some good reasons for that. Some of them are licensing reasons, which we'll talk about, but other reasons are that the foreclosure laws are so long in those states, it can take you 3 years just to foreclose. New Jersey is actually getting a little bit better, but New York is crazy. So we don't tend to want to purchase in those states. And statute of limitations is also a big deal in a lot of states. And we'll talk about that, but you really need to decide what markets you want to purchase in if you're going to be doing this directly, so that you have the experience to make the right decisions. And doing that includes really understanding what that house looks like. So getting either an AVM or a CMA or a BPO or an appraisal. And we like to get in our final due diligence before we buy a note, we'll either get a BPO or an appraisal, because we want to know what's going on specifically in that house. Is the neighborhood a good neighborhood, a bad neighborhood, an ugly neighborhood? I mean, you can get a lot of that online, but having somebody physically go out there and take a look at the property, they can't go in, but they can tell you about how much that property is going to be worth, and they can tell you if that area has been hit with floods or tornadoes or earthquakes or hurricanes or something major's gone on. They can also tell you about sinkholes or hot soil or mold or kind of what's happening in that area. So having a person go out and physically look at that house and knows that neighborhood is very important. So we talked last week about bankruptcies and the different types of bankruptcies. And when I was talking, Larissa, I don't know if you remember this, but was I afraid of bankruptcies?
No, it depended on which type of bankruptcy.
Yes, and we're not really that afraid of either bankruptcy, but we need to know what's going on with the bankruptcy. We actually like Chapter 7s quite a bit because we find that we're able to work with borrowers through our attorneys and get them to either voluntarily start paying on their mortgage again, which works out quite often. It's funny because we have a lot of borrowers that believe that if they filed bankruptcy, that you cannot foreclose on the house. Well, a bankruptcy does not get rid of the lien on the house unless it was stripped. And most of the time, it's not stripped, especially if it's a first mortgage. That's one of the things that makes first mortgages more secure. Second mortgages are more likely to be stripped, but they can only be stripped if there's no equity in the house. And that's why when we talked last week about doing due diligence, you really want to make sure that you understand what that equity is. So typically in a Chapter 7, loans are not stripped. There are areas around the United States that they do some stripping of Chapter 7. And I know a lot of people on the call are from Florida, and that is one of those areas where a Chapter 7 can strip a mortgage. Chapter 13 is typically, however, where you can see that, and typically it's only on seconds. But we like Chapter 13 as well because that puts the courts in charge of making sure that that borrower is making payments to you. And we have some great Chapter 13s where we're getting our payments consistently, and we have been for years, and it's totally fine. And again, what that's doing is decreasing the balance of the debt, and so therefore we're actually gaining better and better position in terms of equity. So either bankruptcy is fine. You just need to make sure that you understand what that means and know how to look for that data so that you don't get stripped. And if you buy right, even if the loan gets what's called crammed down to a fair market value, you're still protected because you bought at a discount and you have that equity built in when you buy. And so therefore, even in worst case scenario and they cram you down, you're still protected. So the other thing that you really need to look at is foreclosures, and especially if you're the second mortgage, because you don't want to be foreclosed and wiped out as a second mortgage. Again, am I afraid of this? Well, no, I'm not. I just need to know what's going on with it. And I can cure that first mortgage if I need to from second position, but I need to know what's going on. And when I'm doing my due diligence, it's really important to know what's happening with that first mortgage, that they're not foreclosing, because if they do, and they do it before you're able to purchase the note, they could wipe you out. The other thing is that HOAs and property taxes can also foreclose on a mortgage. They can even wipe out a first mortgage in some of the states, and actually Florida is one of those states that can happen. So you, again, don't need to be afraid of this. You just need to be able to look at it and know what's going on, because again, that is something that you guys can cure. So
I have a question, Michele, before you go on. On the first mortgage, so let's say you buy a non-performing second. How is it that you put the first mortgage or the first lien holder on notice that you would be willing to possibly cure should the borrower stop paying on the first? How do you handle that? Because it's good information to make sure you understand where the first mortgage is stands as far as whether the borrower is paying or not. But how do you find that information, and how do you put the first lien holder on notice that you would be willing to work with them?
We've done two things, and we do this all the time. So we either call them and just talk to someone at the bank and let them know that we are the second mortgage holder, which is a key phrase, and let them know that we would like, that we're foreclosing on the property or whatever the situation is, and that we are going to cure them and make them whole, and that we are going to go ahead and keep the loan. So we just basically call them and have a discussion with them about that. We also have designed a letter that we send out to them telling them what we want to do as well. Sometimes we do both. It really kind of depends. And in terms of finding out that information, when you buy a loan, you get you order what's called an O&E, and we talked a little bit about this last week. Well, that information, that O&E will have the information of who that first mortgage holder is, so that you know who to contact.
And what if the first mortgage isn't, it's up to date, and then at a later date they stop paying on the first while you're working with them on the second? Is it possible for the first mortgage holder to let you know that, so that if you wanted to cure the first mortgage, you would have the opportunity?
Yes. So when you buy a loan, when you buy it, the loan is being assigned to you. And when you get that assignment, which is a physical document, you're going to record that, so that when they go through their foreclosure proceedings, they let you know that that's occurring.
Okay, gotcha. Okay, thank you.
Sure. So as I was saying, the most important thing that you really need to know is the laws. Everything we've talked about has to do with laws. When we have these major spreadsheets here that go through every single state, what their foreclosure laws are, what their bankruptcy laws are federal, so that's pretty much standard throughout the United States. But if there's anything that's different, homestead, statute of limitations, which I'm going to talk about on this slide, which is probably one of the most important things for you guys to know. We have by state every single one of these different laws, so we know what we're dealing with and what we need to look for, whether it's in our due diligence process or after the fact, if we end up foreclosing, what we're going to be faced with, as an example. So you need to understand the timeline for foreclosure. Some states, as we talked about, New York can be 3 years. So that means you're carrying that note for that period of time. So you want to make sure that you're factoring that into your pricing. There's also, in some states, redemption periods, which means that even after you foreclosed, they have the right to redeem that note. And that can be a pretty lengthy period of time, which means you can't fix it up, you can't deal with it, you can't do anything on it until that redemption period ends. The other thing that can be very long is the eviction times. We had a loan recently in Massachusetts. It took us forever to evict these people. So you need to understand that, and just make sure that you're pricing it into your note, your pricing of the loan itself. So next thing is you need to know about note accelerations. In the documents themselves, which is the note or the deed of trust or the mortgage, there is information in there on what their acceleration clause is. Well, sometimes when borrowers stop paying, the note can be automatically accelerated. And if that's the case, it starts to trigger your statute of limitations. So you want to know on that note, when you're looking at the collateral itself on the note, what that acceleration period is and how it says that. Because a lot of notes will say it may be accelerated. Well, if it may be accelerated, that means you have to give them notice. So if it is accelerated, that means there is no notice given. So you really kind of need to understand that. And then, as I said, one of the most important things is statute of limitations. Every single state has their own statute of limitations. And all of them have specific statute of limitations for mortgages themselves. Some of them are very broad in terms of saying that it's 20 years after the maturity date. Other times, statute of limitations on a note can be 7 years or 3 years after they missed their last payment. So you need to understand that, because this is a really big area right now that a lot of attorneys are hitting pretty hard in terms of trying to get either the full amount that's owed on the note or part of the amount that's owed on the note dismissed. So one of the things about statute of limitations, and I say this very broadly, and this is a longer explanation, but a lot of times just the individual payment is on the statute of limitations, not the entire note itself. So the individual payment that's missed. So if you're going to seriously get into notes, then that's something that you want to learn about. One of the things that's not talked about very often at all is latches. And what latches is when an attorney says to you, well, you could have filed foreclosure 7 years ago or 3 years ago, because that's how long it's been since this person hasn't been making payments. And because you didn't file right away, that means that you're basically putting more burden on this homeowner, and therefore, because you didn't act right away, we don't believe that they owe that debt. So it's not a very common thing that comes up, but it is something that you need to be aware of. And it is something that I fought against in a court case and won. So again, all these things are things that you can deal with. You just need to know how to deal with them. And then homestead. Homestead is in some states really giving the homeowners a break for tax purposes, primarily for property taxes. But in some states, homesteads will allow you to only foreclose on a part of the debt that's actually owed. So you also need to be aware of those laws. And then one of the things that was huge in Florida about 2 years ago, and I know it's still happening, it just doesn't seem to be happening quite as much, but is that they were saying that you had to prove the past servicer's records in terms of the payments that were coming in to the servicer from the borrower, and that it was your responsibility to prove that servicing record. Well, when you didn't own the note and the last 3 companies that owned the note went bankrupt and are no longer in business, it's kind of hard to prove that servicing record. And so that's why that was really coming up, especially in Florida. So there are ways to do that now, but again, just be aware that that's something that you can be hit with. And we talked about foreclosure and deficiency and really knowing those laws as well. I think I've lost control again. Okay, so licensing. Licensing is another area of law that you need to know. When you purchase a note, you're not originating that note. You're just purchasing something that's already been originated. So you don't need to have an originator's license, but you do need to have a license to buy and sell notes in 18 states plus New York City, and brand new in Ohio. This was just done at the very end of March when it came into effect, is for junior liens, you have to be licensed. So that means there's a whole lot of other states out there that you don't have to be licensed in, but just be aware that there are 18 states that you have to have some kind of form of licensing. And it really is dependent on the state itself. So some states require supervised lender licenses. Some states require mortgage banker licenses. It depends on the state itself. So just be aware that that can be the case. Servicers, we talked about origination license, which is what we don't need to have. But if you're originating a loan, you would need to have that. That's not what we're talking about here. We're talking about buying existing loans. So the other thing is that in order to be a debt collector, you also have to be licensed. So that's why we suggest that you have a third-party servicer as a part of your team so that you're not considered a debt collector and you're not trying to collect that debt yourself. So as you can see, it's really, really important for you to know the laws in the states that you're working with. One of the things I will also tell you is that with this licensing, you're also required in most places to get insurance. Again, it changes by the state, but typically that includes the surety bonds. We also recommend that you get E&O insurance, which is errors and omissions insurance, and then general liability insurance. So the next part that I'm going to talk to you about, I have to do my little disclaimer, and that is that we are not offering to sell or are we soliciting a security. What I wanted to do is to talk to you about how you can buy or sell these notes and the different options that are available to you. So we'll start with performing notes. So with performing notes, one of the things we talked about last week is that they're really great for IRAs because you're just getting that interest income every month into your IRA to help build that. And the other thing that's really nice about performing notes is that you can purchase a large amount or a small amount of a performing note. You can purchase a whole note, or you could purchase part of a note. And you might want to do that if you only want your investment out for a specific amount of years, or you only have a limited amount of money that you could put into the note. Well, the return is based on debt. So that's pretty nice because, again, from a protection perspective, as they pay that note off, you're more and more protected. The loans are amortized, so you're getting that interest income. And typically, as we talked about reperforming notes, you want to have at least a 6-month, if not more, performance track record. Performing notes means that that note has not ever missed a payment. So typically what we find is that investors are getting a 6 to a 9% interest on performing notes. Again, they carry very little risk or a lot less risk than non-performing notes. So your interest that you're going to be selling this note for or buying this note for is not going to be as high. And one of the things that we always do, and we absolutely recommend if you do, is that we provide the assignment itself to people for additional protection. So what does that mean? That means that if something were to happen to us, that note, there would be an assignment of that note, especially if it's in a fund, to the investor or the investors so that they could do something with that note. So it's just an additional protection. And I know a lot of you probably don't do this or haven't seen it before, but it's something you should look for and something you should make sure that you get, because you never know what's going to happen in life, and something could happen to the person that's managing this. So you want to make sure that you have the ability to take over if you need to. And the other thing is there is servicing fees. As I told you, we have third-party servicers that manage all of our loans, and it depends, we still interact with those servicers and we help manage those servicers, but with that, they do charge a servicing fee. We feel that that servicing fee is very reasonable. Performing notes are typically about $15 a month for that servicing. And they do all the 1099s. They do everything in terms of managing that note for that $15. So for us, it's absolutely worth it. The other thing that you can do, especially if you're doing non-performing notes, is you can have a fund. And there are many types of funds out there that you can get. There's a 506B, there's a 506C, and the difference really between those two types, and there's a lot of them out there. There's nonprofits, there's all sorts of them. But when we look at these two, a 506B or a 506C, the biggest difference is whether or not you can advertise or not, and whether or not you can only have accredited investors or non-accredited investors. We like the 506B because what it does is, even though we cannot solicit and we cannot advertise, you could have sophisticated and accredited investors. So it gives people that don't have at least $1 million worth of net worth, or make $250,000 a year together, the ability to invest. So therefore, it creates a lower entry point. Also, typically when funds are put together on non-performing notes, the equity is split. So whatever the person is making, that's managing the fund, makes in profit, that profit is split with the investors that you have. The other thing is that it'll incorporate that licensing we talked about. So if you're investing in a fund, you don't necessarily need to be licensed, but whoever has the fund would need to be licensed. You can also split it up with that type of investment so that you can have groups of notes within an individual investment, which helps diversify your overall investing. So, or whoever you're having invest with you would be diversified in the amount of notes or the type of notes. So if they have a really high risk tolerance, then you might want to put them into seconds because they want to make more money. But if they have a low risk tolerance, you could put them into firsts. And what's nice about a fund is you can kind of split that up if you set the fund up right. The other thing you can do in a fund is you can set up some extra reserves, extra money for reserves. So you make sure that you have the ability to pay those attorney fees, to do those rehabs, to pay the servicing fee, and that you have that money to be able to do what you need to do on that note and still give your investors a good return. The other thing, as we talked about before, assignments for protection are really important, and you can do that in a fund. And you can also, if you want, charge a management fee for managing that fund. So those are kind of some of the things that you can do. And I wanted to talk about some of the mudslinging that goes on in the industry. And if you're going to be buying notes, it's not necessarily for the faint of heart type of person, because you need to know that sometimes you're going to have some mud slung at you. And the first thing that happens is that you are perceived, no matter what you are, as the big bad bank. So you need to know that going in, that they're going to come at you as you're the big bad bank. And as we talked about with latches, a lot of times when you're in court, you're the one that's going to have to show the burden of proof that the borrower didn't make these payments, that you have the servicing records, whatever that may be the case. And the other things the courts really like is they really like you to try to do a workout with the borrowers. That is, in essence, our strategy anyway, so that's typically not an issue. But you need to know going in there that that's what the courts are looking for. They want to know that you're trying to help this person out. And, in general, really just kind of show reasonableness in what you're doing. So how are you going to overcome these objections? Well, these are the things that you need to be able to overcome. And a lot of that's really going to be done in your due diligence stage, which is why we spent so much time on it last week. So as long as you are prepared and know your laws, then you have the ability to have a defense against all of these things, acceleration of mortgage, statute of limitations, all those things, because you know where your note is in relationship to that. You also want to make sure that you buy notes with equity. We talked about the possibility of another real estate crash. If that's the case, then you want to make sure that you have equity in your notes, and that's going to help you not only stay ahead of the game, but also if they file bankruptcy, it's going to allow you not to be crammed down or stripped. One of the things that borrowers used to throw at me all the time is that I paid pennies on the dollar for the note, and therefore I can't collect all this money. Well, that's a false statement, because as you saw in the pricing section, we don't pay pennies on the dollar anymore. But two, even if we did, we do it based on the risk, and that's not the only expense we have on the note. And so you're able to get over that. And the other thing is we typically have to buy millions of dollars of notes, so therefore we get a discount based on what we're buying. So people will throw that out to you, but it's very it's kind of a silly argument, honestly, and it's fairly easy to overcome. The other thing they're going to throw out to you is that the documents that you have are not valid. Well, we talked about that and making sure that you do have valid documents. And remember, there's third-party people that will help you do that, and that the payments are being made, and that we have an accurate record of when payments were stopped and how it was applied to the loan. And as long as you get those servicing records of that, you're fine. One of the big things that used to happen to me a lot, and still does, is that they would say, well, I filed bankruptcy, so you're not allowed to foreclose on me. Well, as we talked about in the bankruptcy section, I can foreclose on them. But a lot of times your borrowers don't realize that. There's a lot of attorneys out there that don't actually give that information to the borrowers. They think that because they're filing bankruptcy, they actually no longer have a lien on that house. And unfortunately, that happens quite often, where they think that lien is stripped in addition to their obligation to pay. And that's just not true. But a lot of times you have to explain that to them. It's funny how many borrowers that I have that think that because they're paying on their first, when I hold a second mortgage, that because they're paying on their first, that I can't foreclose on them because their first is current. Well, again, that's a false statement. So you just have to be able to overcome all of those types of objections. So how are you going to get out of the mud? Well, we've talked about this a lot, but your team is really the team that's going to help you get out of the mud. As long as you do your due diligence with your team and you let them help you throughout the process, they will make sure that you get out of the mud. And all of these organizations are critical team members to us. We have realtors all over the country that specialize just in REOs and different things like that work with contractors. We have foreclosure and specifically bankruptcy attorneys. And all of these people here will help you in terms of what you need to do in terms of buying your notes and selling your notes. So the bottom line is, don't get stuck in the mud. Make sure that you do your due diligence. Make sure that you understand what the mortgage says in terms of acceleration, what the statute of limitation is. Make sure you're buying in markets that you understand if you're going to be doing this directly. And work with sellers that are responsible. Make sure they follow the laws. And just to give you an example on that, in in Georgia, we'll say, because it's the whole state, not just Atlanta, it's actually illegal to sell one note to someone that's not licensed to buy it. So just even the sellers need to make sure that the person that's buying the note is licensed. So you want to make sure that as sellers, they're responsible and as well, and that they're doing the right thing. We actually really love Georgia because we are licensed in Georgia. And as a result, we have opportunities that other people don't have because of that licensing. So you can actually look at it as a good thing as well. And you want to make sure that that seller is providing you good documents, that they're all there, and that they're doing it in a timely fashion. We talked about using your team to help you with uncooperative borrowers, with documents, all that type of thing. And so that is one huge way of making sure you don't get stuck in that mud. And then lastly, you need to make sure you stay on top of your notes. You need to make sure you're following those foreclosure timelines and the bankruptcy timelines. You're following up with your borrowers, and that really you're protecting your assets, especially if you guys have investors that you're working with. You want to make sure that you're able to, you're not putting that investment at risk. And by following up and knowing your timelines and being on top of your stuff is how you're going to make sure that happens, that you're not putting those investors at risk. So be a good risk if you're raising money. Make sure that you gain experience, that you're not just doing your first note with an investor, because you need to know all the things that I've talked about. If anything, I've probably done a really good job of scaring you. So hopefully you understand that you need the experience in order to buy notes. And know that you make your money when you buy. As we talked about last week, that's actually one of the most important things, is that you make your money when you buy. And so doing your due diligence correctly so that you can make that money is important. And you can match the asset types to the investor types. So if they're very risk averse, you're able to put them in a more secure type of investment like first mortgages. And you, as someone that they're doing business with, you have to have your own good financials. If you don't have your house in order, it's not fair to be putting investors into something that you're selling. And having reserves, we talked about this last week quite a bit, but making sure that if something does go wrong, you have the reserves to be able to handle it, that you have the reserves in addition, because you might have to foreclose. As I talked about, our success record is 72% getting loans reperforming, but that's actually unusual for the industry, which means all the rest of those loans we probably had to foreclose on, and that requires rehab in most cases and attorney's fees in most cases. So you need to make sure you have the reserves for that. We also talked about a third-party holding assignments for investors, essentially assigning those notes over to investors, but having a third party hold them so that if something were to happen to you, they have some kind of recourse. Communication is key. One of the things that gets investors or gets people that buy notes or even real estate investors in trouble is if they have other investors in their deal, they're not communicating about what's going on. And I think lack of communication is what scares people the most. So you got to be transparent. You got to let people know what's going on. You got to let people know the good, the bad, and the ugly. I mean, and people understand that not everything is going to go perfect to plan, but as long as you communicate it and you're transparent, they're usually a lot more accepting. So lastly, have a succession plan. If something were to happen to you, how are these notes going to be handled? I'll give you an example. My husband is a pilot. He's a private pilot, and we fly. And so if something were to happen to us, I would want to make sure that there's some plan in place so that people can act on our behalf. So having that plan is very important. Okay, so this is the last slide, and these are your success musts. We've talked about this really in depth here, so I'm not going to go into it, But the only thing I would stress here is you really need to make sure you're managing for that downside and know what your exit strategies are. We talked about the opportunities in notes, which are probably more than any other thing I've ever done. And there's more exit strategies in notes than any other investment I've seen, which makes it a wonderful and exciting investment. But you need to really know those exit strategies so that as you start working through your notes, you know what's going to be the best exit strategy, not only for the borrower, but also if you do have investors, for those investors. Okay, 16 minutes late due to our thunderstorm, but I think I'm done.
Yes, and that's okay. I do have a question. I wanted to know that when you buy like a pool of notes and you're doing your due diligence, do you find that will the bank, like if you find a few that are that they just don't make sense, or that will the bank negotiate and allow you to say, okay, I'm not going to buy these three, but I'll buy the other notes? Will they allow you to do that, or if you buy the pool, do they say you have to take all of these notes?
It depends on the bank. So a lot of times, if you can prove that there's good reason for not taking that note, for example, they tell you that it's secured and through your due diligence you find out that it was foreclosed on or something like that, then they will allow you to drop that note out. However, some people put out pools of notes knowing that some of them are not necessarily going to be secured, or there's going to be some kind of issue with that. And they will require you to buy that entire pool. But what that means is when you go into that type of relationship, you would price it knowing that some of those notes are not going to work out. So it just kind of depends on who you're buying from.
Okay. Another question that popped up, when you talked about the redemption period, what is, because you said it can be quite lengthy, what are you talking about when you say they could come back and redeem the note? Are we talking 6 months, a year, just kind of on average, what do you see?
Yeah, it really depends on the state. All the states are very specific. Some states have no redemption period at all. In Colorado, we have, the buyer, the borrower doesn't have a redemption period anymore, which they used to have, I think, 60 days or something. But second mortgages actually have a redemption period here of like 3 days. So it really depends on the state. I've seen some states up to a year. So it's very, I don't know, I've never added all the states up and looked at an average. I would say overall it's probably a pretty low average because not all the states have redemption periods.
Okay. I had a attendee ask if you wouldn't mind sharing some of the names of probably nationwide note servicing companies, if you have any that you use that would work nationwide.
Yeah, there's a lot of them out there, and they're welcome to give me a call. It really kind of depends on what you're looking for. There's quite a few out there. I will tell you that all servicing companies they seem like they all have an issue. And that's why I'm saying it's probably best to call me, because it depends on what you're looking for. But, some of them aren't very good at collecting, but great at accounting. Some of them aren't the best at accounting, but are good at collecting. So it just kind of depends on what you're looking for in a servicer. But there's probably, I don't know, there's a number of them that are nationwide.
Okay. All right. Perfect. And just as a reminder, Michelle's contact information is on the screen. I did not have any other questions pop up. So at this point, we're going to end the webinar. Keep in mind, if you are on and you didn't hear the first part, the recording is going to be made available to you through email. So we'll send out this recording as well as the recording for the first webinar. Before sending it, we will edit out the pause that we had due to the lightning storm that Michelle encountered. So we'll go ahead and make that edit for you. So when you listen back, it should be just about an hour long. If you guys do have questions, please let me know, or go ahead and reach out to Michele. And with that, I thank you so much, Michele. This was very, very informative.
Great. Well, I appreciate it, Larissa, and thank you all for putting up with our lightning storm. And I hope this was of value to you. We really try to put out information that's helpful. So I hope that was the case. Anyway, have a wonderful day, and thank you so much. Bye-bye.
Thank you. Bye-bye.